Good day, I am Jamalai Sabaluma and I am going to report the Chapter 13 Organization for Office Administration and Control. Objectives: to briefly understand the Organization for Office and Control, to explain the importance of Organization for Office and Control, and to present Organization for Office and Control. No business runs itself. It needs repeated stimulation. It is not easy to build a business. It takes time, intelligence, and hard work. A business will run smoothly only if proper attention is given to it. A group of unarranged machines, a body of unarranged workers, and a pile of unassembled materials do not make a going concern as to what is to be produced, to whom it may be sold, who is to do each part of the work, when the goods are to be finished, whether the quality is satisfactory, however money is to be collected and paid out, and how to settle a wide range of problems. All of this must be administered and controlled. Administration and management. The function of administration and control is to keep the business going smoothly, to supply the necessary stimulus and direction, and to look ahead for possible opportunities as well as danger signals. The act of administration refers to the establishing and maintenance of major policies, while management refers to the carrying out of implementation of those policies. Management problems. Management problems may be grouped namely: first, problems of policy, which involve the setting of major objectives and formulating plans of action for their attainment. Second, problems of organization, which involve the classification of activities into administrative groups, fixing responsibility for the performance of each group, and providing for the performance of each group and proper coordination of all the groups in order to cooperate effectively in the attainment of the objectives. Third, problems of personnel, which involve the procurement, development, and use of individuals to perform the responsibilities established by the organization plans. Fourth, problems of facilities, which involve the procurement, maintenance, and use of the physical factors needed in the performance of the operations necessary in the attainment of the objectives. And fifth, problems of method, which involve the establishment and use of the routines and procedures required to perform effectively the operations necessary to attain such objectives established by the policies. Meaning of control. The following are taken from E. Robinson, Business Organization and Practice, and from David Stetson, Office of Administration, published by Alexander Hamilton Institute. Control may be understood if it is broken up into several aspects of knowledge. First, knowing exactly what work is to be done, A as to quantity and quality, B as to time available. Second, knowing what resources are available for doing the work, A as to personnel, B as to materials, C as to equipment, and D as to other facilities. Third, knowing that the work has been done or is being done, A with the resources available, B within the time available, C at a reasonable cost as compared with standard cost, and D in accordance with the required standard of quality. Fourth, knowing immediately of any delays or variation, A as to the happening, B as to the cause, C as to the remedy. Fifth, knowing what is being done to remove such hindrances, A as to who is doing it, B as to how he is doing it, and C as to when it will be done. 6. Knowing when it is done as to time finished, A as to quality of the finished job, B as to who do it. And lastly, knowing that recurrences are guarded against, A in what way, B by whom, C at the what cost, and lastly with what system of inspection. Elements of control. Control, in order to be effective, must be afforded with necessary elements such as authority and knowledge, guidance and direction, and constraint and restraint. To exercise control, the manager must be able to know what the situation is and what it should be. He should know what to do to bring the situation into line. Equally important is to have authority to undertake necessary and appropriate action. In the execution of control, the manager therefore must have his lines of communication established, open, and functioning. In every management problem, there is present a multitude of elements and conditions. Some of these are desirable and which the manager would like to retain. Others are undesirable, and have to be eliminated or discarded. Controlling, therefore, is to conscious directing or influencing of certain causes so that certain desired results could be effective. Administrative controls. A basic task of management has to do with control, together with planning, organizing, coordinating, and directing. Control is one of the functions of management. When management introduces rules and regulation, standard operating procedures, and standard orders, and when it is a see to it that these are followed, order to attain the company's objectives, it is establishing and enforcing controls. Production control, earlier discussed under manufacturing, is a form of administrative control, so as an inspection. The most common form of administrative control, however, is budgeting. The budget. The budget is a collection of estimates of income and expenditures for a future period based upon past experience, present conditions, and anticipated future trends. The budget is a thought of management whereby it hopes to achieve the highest reasonable expectation of operating efficiency. The business budget, being a tool of management, is only as useful as the care with which it is prepared and the manner it is followed. It makes management regularly study financial conditions, the markets for the company's products, and properties of the general market. It points out disruptive or unusual elements that must be given careful attention. It brings about a coordinated use of systems of accounting, books, records, and the findings of research. A budget may cover a single item of expense such as the advertising budget, or it may cover an entire department activity such as the sales budget or the purchasing budget. The term budget is used singly, however, it is usually refers to the entire budget of the business enterprise. The budget may be prepared in terms of months or quarters or for a year. It should be long enough to include complete cycles of seasonal fluctuations of volume, production, merchandise, turnover, and financial operations. The preparation of a budget, the president or general manager usually calls a conference of all the top executives or department heads. The general plans for the coming budget period are taken up. The conference discusses changes in the company policy, after which important changes in department policy are made known to the rest. The department needs to prepare their own respected budgets, which are turned over to the budget officer for coordination. This budget officer may be the chief accountant, the comptroller, or specific official whose principal task is budget making. This coordination of department budgets and their integration into the overall budget may be the work of a budget committee. If another conference of all department heads is found necessary, one may again be called. In preparing the separate budgets of departments, the sales budget is usually attended to first. This is because the largest part of the income of any company comes from sales, and the forecast of sales for the coming budget period will form the basis of other department budgets. Sometimes, a sales expense budget is prepared separately. The cost of maintaining the sales department or salaries, overhead, and the like are included. Sales promotion may be part of sales expense. If important enough, it may also occupy a separate item in the overall budget. The production budget is geared to meet sales requirements. What are the physical quantities to be produced? How much finished goods are on hand, and how many should be on hand at the end of the time period? What are the physical requirements of the plant? How much production can a company finances permit? All these questions have to be answered. The production budget enables maintenance of an even rate of production and cuts production cost. Timing and schedules are attended to. In preparing the purchase budget, inventories are checked and production requirements both as to volume and as to volume are carefully studied. The purchase budget is usually broken up into monthly budgets to make the financial needs clear and to find out when the company needs money the most. The finance budget gives overall income and expenses over the whole period to enable management to see the overall financial picture and arrange for loans or other resources of finance. The business budget must be continually compared with actual performance once the budget period gets underway. It should be adaptable and permit revisions not originally foreseen. Government controls. Business in the Philippines is essentially characterized by free enterprise but with many elements of government control. The business enterprise and the company as a whole are subject to a persuasive and comprehensive system of government controls. Government control may consist of regulation. Regulatory agencies such as the Securities and Exchange Commission, Public Service Commission, the Patent Office, and the Insurance Commission are quite well known and exercise familiar functions. The government enforcement of pure food laws, labor laws, social security legislation, anti-monopoly laws, and even tariff, customs, and revenue codes is an example of government control of business. Public control may become more direct when a government agency invests sizable amounts in a business or buys it outright. Loans from government financing institutions are often accompanied by government officials sitting in meeting of boards of directors of private corporations. Accounting controls. Accounting has been defined as the collecting, summarizing, analyzing, and reporting in monetary terms of information about the business. Accounting provides information for two distinct groups. It gives information on the company's finances to stockholders, government offices, creditors, bank, and other outsiders. As a tool of control, however, it gives information to management to enable it to realize the company's objectives. As a tool of control, accounting communicates to all personnel in concrete terms of pesos and centavos just what management wants the employees to do. It motivates personnel and enables review or checking up of their efforts and activities. A special branch of accounting, cost accounting, enables effective operation based on accurate cost information. Importance of controls. Controls give the usual advantages of planning waste. Inefficiencies and dishonesties become known and may be easier avoided. Controls bring out conditions which otherwise would remain unaddressed. More importance, future problems are provided for, since control are intended to keep an enterprise focused on its objectives. Goals and objectives are formulated in clearer and more concrete form. Controls increase initiative, bring about coordination, and promote cooperation. And I will end my report by saying, change the changeable, accept the unchangeable, and remove yourself from unacceptable.